Welcome back to Inside Track. We want to show you a very cool chart which shows something strange is going on in the German stock market and the U.S. stock market. We put them together and you can take a look. All year long, they've been moving basically in tandem, right together, almost tick for tick. And then look what's happening in the past few weeks. The U.S. stock market, which is in the white, that's the S&P 500, is doing a lot better than the stock market in Europe, as the headlines have been coming fast and furious out of Europe and seems to have been doing a lot worse. We can attribute that, Steph, right to what's happening in the bond market with those yields rising.
You know, bond guys are starting to say, wait a minute, maybe we're not agreeing with the equity market. Maybe Europe is worse than we think. And so it would be great to hear from Chuck Mounts, who's with us this morning.
Yes, we invited him here from Knight Capital, a friend of InsideTrack. He has a new report out on Spain and why, if you think Italy's bad, Spain is a whole lot worse. And just tie it together, Chuck, with what we just saw, the S&P 500 versus the German stock market. Investors are looking to the U.S. now, perhaps, to shield themselves from the whatever pain in Spain and in Italy.
Right. I'd say finally we're seeing some rational response to actually the scale of the problems that we're having in Europe. And when you look at peripheral Europe, you know, if you go back a year ago or 18 months ago, it was Greece. Then it became Greece, Portugal, and Ireland. Now it's Greece, Portugal, Ireland, Italy, and Spain. So the crisis has just continued to escalate. The policy response out of Europe has been inadequate from the beginning.
But why is Spain so important now?
Spain is so important because Italy has already moved into the status of a live catalyst, and Spain is moving into the role of a live catalyst as well. Italy is a very straightforward sovereign debt story. It's not a complex banking story, over-levered banking story, over-levered consumer. So the policy response in Italy to fix their problems are pretty straightforward. Spain, however, is a much more complicated story. It's one of fiscal imbalance with a debt spiral coming without meaningful policy action from the government, combined with a highly leveraged private sector, the most highly leveraged private sector in Europe after Ireland, and a banking system. So if you have
Greece, Italy, Spain, what's next?
Well, that's the problem, that once you move beyond these peripheral European countries, core Europe is next. And you're starting to see that pressure emerge, whether it's in Belgium or whether it's in France, with CDS spreads widening out and markets starting to react. I've heard from investors many times that Spain is different from Italy, and that goes back. Ireland is different from Portugal, and Portugal is different from Greece, and so it's a long track of that line of thinking. And I do agree. Right, Spain is different from Italy, but it's still part of the same group.
In Ireland, saying Ireland is not Greece. They were selling T-shirts.
But
seriously,
in its own way.
Spain is not Greece, and that's an important distinction.
Spain is not Greece, and it's not Italy either. But the policy responses in Spain are very complex and almost mutually exclusive. If you're trying to fix an over-leveraged private sector and you're trying to grow economic growth to restore balance in the fiscal sovereign side, those are almost mutually exclusive policy options.
How big are Spanish banks? Is there an issue around U.S. banks using Spanish banks as a counterparty?
I think that's why the Spanish story is a little bit different, because of the interconnectedness through the financial system. If you look at European bank exposure into Spain, it's around 800 billion euros. That compares to Italy's around trillion euros. But still, 800 billion is huge. But on top of that, the Spanish, so you have a lot of financial connections from within Europe coming in their connection to Spain, but you also have Spanish banks being big investors outside of Spain. So the biggest points of destination for investments for Spanish banks are the UK, the US, Brazil, Mexico, and Portugal. So there's a lot of transmission mechanisms coming out of Spain that you might not see from the other peripheral economies.
Ay, Dios mío, Chuck Mounts.
A warning there on Spain. Thanks very much to Chuck Mounts. He is the managing director of Knight Capital.